So the rules for buying and selling a condo just changed. 6 changes, 4 different dates, and we're going to walk through how to navigate all of them. Skip this and you'll find out 3 days before closing, after the inspection, after the appraisal, after the movers are booked. So welcome back to Apply with Eric. I'm Eric Hamilton. This channel is where complicated housing rules get turned into plain English before they cost you money. No hype, no jargon, just what to do next. If that sounds useful, please hit the subscribe button and tap the like button so the next buyer who sees this will actually get the information that they need to make an informed decision. So let's get into it. Today I'm going to walk you through 3 things. What actually changed with condo loans this year, why any of it matters to you, and exactly what to do whether you are buying a condo or you're planning on selling a condo. Buyers and sellers both need this because you are standing on 2 sides of the same building. So let us start with the one idea everything else hangs on. When you buy a condo, you own the air inside your walls, your floors, your paint, your kitchen. You do not own the roof. You do not own the elevator. You do not own the boiler, the pipes, or the parking deck. You own a share of all of that with every other owner. So you are buying a home and you are also buying into what we would look at as almost like a small business. Now let me explain that small business because everything else today comes from it. Think of the building like a household. It has money coming in, that is everybody's monthly dues. It has bills that are going out, that takes care of the heat, the water, the insurance, the landscaping, management, and any repairs in the building. And it should also have a savings account. That savings account has a name and we call it reserves for the building. Here is why the savings account is the whole ball game right now. Every big thing in a building has a clock on it. A roof does not last forever on the condo building. Neither does the elevator. Neither does a boiler or a parking deck or any of the windows in the building. Those are not if, it's a matter of when. So there are only 2 ways a building handles a new roof. Way number 1, the building saved a little every single month for years. The roof gets replaced out of that savings. Your monthly dues barely move, and you might not even notice that it ever impacted you financially. Way number 2 is the building did not save, and this is what we keep seeing over and over. The roof still needs replacing. Roofs do not wait, they just need to be done. So the money has to come from somewhere, and it ends up coming from you. Every owner gets a bill in the mail for their share. That bill has a name too. It's called a special assessment. It can be a few $100s, it could be tens of thousands of dollars, and you do not get to vote on whether you feel like paying it. So when I say a budget matters, that is what I mean. The budget tells you which building you are standing in. Way number 1 or way number 2. Now, here is why the lender cares just as much as you do. The lender is putting money into a unit inside that building for the next 30 years. Now, let's think about this a little bit. If that building has no savings, that's going to lead to some surprises for the owners. Those surprises lead to some owners who cannot pay. Owners who cannot pay lead to less money coming in to put into that savings account or reserves. Less money coming in leads to repairs that get delayed over time. Delayed repairs lead to a building nobody wants to buy into, and that's what we call deferred maintenance. It could just be a roof, it could be an elevator, it could be windows. That creates stuff that piles up that needs to be done. And that is when everybody's unit tends to become worth less because it's not being taken care of. Not just the broken one, all of them together. So the lender looks at the savings number because that one number predicts the whole chain. That is what changed this year. The bar just moved, which means 2 things you have to be approved. You have to be approved as a borrower and the building needs to be approved. You can pass with flying colors and the building can still fail. Now here is what changed. On March 18th of this year, Fannie Mae sent out a letter to all lenders. Freddie Mac matched it the same day. So they were obviously working together on this. And there are essentially 6 changes. So I will try to keep this short and I will tell you why each one matters. Change number 1, there used to be a quick check that we would do for a lot of these buildings. It was called a limited review. As of August 3rd, that is gone. Why does that matter? Under the quick check, nobody opened up the budget. A building with almost no savings could sail right through approval. Now, most buildings get this deep check and somebody actually goes through those reserves. Change number 2, small buildings got easier. A building with 10 units or less can now skip the full review. So this is somewhat good news. Why does it matter? Small buildings used to get stuck for paperwork reasons, no money reasons. That is fixed. A lot of them don't keep good records of this stuff because they're small, self-managed, and not managed by management companies. So this does help us out a little bit. Change number 3, the savings rule is going up. So when we talked about reserves. Today, the budget has to put at least 10% of its income into savings. On January 4th of next year, that will now be 15%. So why does that matter? Some buildings that qualify today will not qualify in January. Nothing about the building changed. The bar was just moved. Change number 4, some buildings use a savings study instead of that percentage. Now they have to fund the highest number in that study, and it's called a reserve study. Why does that matter? There used to be a version of that study that basically let savings drift towards zero. That version is gone. Change number 5, the old cap on how many units in a building could be rented is retired. That is good news. Why does it matter? Good buildings downtown were getting turned down just because a lot of the owners had started renting out of their previous units when they moved somewhere else because the rental market was so strong. That wall came down, so now there's no limits on rentals. So again, some of these changes are good, some of them are bad. Now there will be some that do not like the fact that they're living there and they're all rentals. Some people don't like that, but now those rental restrictions are removed. Change number 6 is insurance, and this is the big one. The building policy can have a deductible for each unit. It cannot be more than $50,000. And if there is one, you have to carry your own policy that covers it. Why does this matter? Insurance pays for the big stuff minus the deductible. Somebody has to cover that deductible, and that somebody is usually the owner. So a building can pass every single test, and you can still owe a large bill if something breaks. Ask what that number is. Then make sure your own policy covers it. One more that is not on the list but decides deals every single week is late dues. If more than 15% of the owners are 60 days or more behind in their dues, that is going to be a hard stop. Why does it matter? A budget is only a plan. Late dues tell you whether the plan is actually working. The budget can say one thing, while the bank account that the HOA keeps can say something completely different. So that is the what and the why. Now here is the how, and this is the part that's going to be shorter than you expect. If you are buying, your whole job is 2 things. Number 1, get fully approved before you shop for any type of home. Not a quick letter, a real review of your file, income, assets, everything. That takes care of your half of the purchase. Number 2, when you find a building that you like, send us the address. That is it. All we need is the address. Let us take care of the other half. Here is what happens on my side so you know what we are handing off. My team pulls the association documents. We look up how many loans that we've done in that development, and we do all the research based off of previous loans that we've closed. We find the savings number in the budget. We read the board meeting notes because the board talks about problems out loud long before they mail a bill. We read the insurance page and find out the deductible. We check how many owners are behind on dues, and we check which review path the building falls into. Then we come back to you with plain language response. You do not have to order anything. You don't have to read the budget. You don't need to decode an insurance page. You do not need to chase a board or a management company. We try to do all of this for you as long as we have the cooperation of all parties. You get an answer you can act on before you write the offer. Now, if you're not working with my team, do not walk into this blind. I put in a free 1-page guide that will be in the description. It'll list out which documents to request, exactly what to ask your lender before you fall in love with the unit. Print it out, hand it to your agent, use it with whoever you choose that's going to help you purchase your home. It works whether you work with me or not. Now, if you're selling, same idea applies. Your list is short too. Number 1, send me the address before you list. Number 2, this is really important. We're going to review the building and tell you which buyers can actually close on your unit. That is what tells you how to price it. Number 3, if something is fixable, we tell you and your board exactly what to fix. A board that adjusts its savings line can restore financing in every owner in that building. And number 4, if it's not fixable this year, you find out now, not week 6 with a dead deal that fell apart because the lender didn't do the work up front. Again, we handle the document work up front. You do not. There is a free 1-page guide in the description for sellers and listing agents too. I tried to lay out everything we can to help you walk through this process. Now let me tell you why the timing matters so much. When nobody checks this stuff out front, you don't find out early, you find out late. The buyer has already paid for the inspection, already paid for the appraisal, already paid for the attorney in many cases, sometimes already given notice on an apartment lease. That money is spent and most of it does not come back. The seller is also worse off. The home sat off the market for weeks. Every other buyer moved on. Now it goes back on the market as a listing that already fell through once. Buyers treat that like a warning sign, whether it's fair or not. And that usually shows up in the price. So think about the cost in two ways. Do the work up front costs you only one email with an address. Skipping it costs you real money, weeks of time you can't get back, and a level of frustration and disappointment nobody signs up for. Same information, very different outcome. The only thing that changed is when somebody looked and they did the work up front. So here are your tools. Go to 100homebuyers.com to get fully approved before you shop. Grab the free one-page guide that's in the description. One for buyers, one for sellers and agents, one for HOA boards, and a plain English summary of every change and every date. And send me the address of any building you're looking at. This is the whole ask. Now, I want to end with one question I get more than any other. What if the building does not qualify? Do we still have options? The answer is yes, we do. We do a lot of portfolio loans and condo projects. And those loans, we keep in-house instead of selling them. And they close deals that other lenders turn down. And I do a lot of this business. It's a big part of the business. So the answer is yes, we have options. But yes is not the end of that conversation. It's something we always have to discuss with people. It's a start of an option because the real question is not can we get it done? The real question is should we get it done? This is actually why it's so important, and here's why it matters. A portfolio loan solves for your purchase. It does not solve your sale. Play it forward to the day that you actually sell that unit. If the building still does not qualify, your buyer hits the same wall that you did when purchasing the home. No buyer with 3% down, no buyer using an FHA loan, just cash buyers and portfolio buyers. That is a much smaller crowd. Fewer buyers usually mean a slower sale and also slower appreciation. And a slower sale and appreciation shows up in the price. So we sit down and we go through it together. How long do you plan to own it? Is the board actually doing something about it? Is there a timeline to fix what's wrong? Is the price already reflecting the smaller buyer pool? Or are you paying like everything else is normal? Because this is a status, not a sentence. Boards fix this all the time. Sometimes the answer is yes, but it's exactly why this has to make sense for you. Sometimes the answer is no, and I'm gonna tell you that too. Either way, you decide with the whole picture and all of the data in front of you. That is a conversation every condo buyer should be having, and almost nobody is having it. So let us have it before you write the offer, not after. Grab the free guides in the description to help you learn a little bit more about what to do and what not to do. If you know somebody buying or selling a condo right now, send them this video. It may help them save themselves from a lot of frustration. And if you have a building you are looking at, put the address in the comments or send it to me and I'll go through and try to figure it out. See you in the next one.